Now we will discuss about the double entry system. This particular double entry system is introduced by Luca Paciano in 1494. So normally double entry system plays a very important role in this accounting. So the major objective of this particular double entry system is that every transaction will be having two effects. Every transaction will be having two effects. So the golden rule of this particular double entry system is every corresponding debit will have a corresponding credit, every corresponding credit will have a corresponding debit. So this is something which is said by this particular double entry system. So its major objective is that every accounting transaction will affect two accounts. Every accounting transaction or every financial transaction will affect two accounts. One account may increase, another account may decrease, or two accounts may increase or two accounts may decrease. So in a simple way, double entry system says that every financial transaction will affect two accounts. Either two accounts may increase, either two accounts may decrease, either one account may increase and one account may decrease. So this is about the double entry system, and this particular double entry system is introduced by Luca Paciano in 1494. So whenever you are speaking about this double entry system, you need to remember that a corresponding debit will have a corresponding credit, a corresponding credit will have a corresponding debit. So this is the golden rule of this particular double entry system. So in this double entry system, we majorly discuss about two important terms. One is debit and another one is credit. Two important concepts, one is debit, one is credit. What actually this debit is? So in a general way, debit means benefit giving activity is known as debit. A benefit giving activity is known as debit, and the benefit receiving activity is known as credit. A benefit giving activity is known as a debit, a benefit receiving activity is known as credit. Now we will try to understand this particular double entry system with an example. We will be trying to understand this particular double entry system with an example. Suppose example, two vessels are there. This is vessel 1 and this is vessel 2. Two vessels are there, nothing but two cans are there. Let us assume that two cans are there. This is can 1 and this is can 2. Can 1, can 2. Let us assume that now both the cans are having 20 liters of water. Both the cans are having 20 liters of water. Can 1 is having 20 liters of water and can 2 is also having 20 liters of water. Now there is a transaction that 5 liters of water was transferred. 5 liters of water was transferred from can 1 to can 2. So there is a transaction that there is a case that 5 liters of water is transferred from can 1 to can 2. Now we will try to understand this double entry system with this example. Two cans are there, both the cans are having 20 liters of water each, and there is a transaction that 5 liters of water is transferred from can 1 to can 2. Now we will try to apply this to the double entry system. Now what does it mean? 5 liters is transferred from can 1 to can 2. Now what does it mean? There is a decrease of 5 liters in can 1. There is a decrease of 5 liters of can 1. Nothing but your total availability of water in can 1 will be 15. Because 5 liters is transferred from can 1 to can 2. Nothing but 5 liters is transferring from can 1 to can 2. Nothing but there is a decrease of 5 liters in can 1 and the total water, the net water will be 15. And in can 2, there is an increase of 5 liters in can 2 and the total availability of water in can 2 will be 25 liters. Total availability of water in can 2 will be 25 liters. Now if you apply this to the double entry system, Transferring of 5 liters of water from can 1 to can 2 is a business transaction. Let us assume that it is a business transaction. Now this transaction has affected two accounts. Let us assume that can 1 is one account and can 2 is another account. Transferring of water from can 1 to can 2, let us assume it as a financial, nothing but a business transaction. Can 1 is considered as account 1 and can 2 is considered as account 2. Now what double entry system says, every business transaction will affect two accounts. In this case also, transfer of water from can 1 to can 2, it also affected two cans. There is a decrease of 5 liters in can 1, that is one effect. There is an increase of 5 liters in can 2, that is another effect. There is an decrease of 5 liters in can 1 is one effect, and there is an increase of 5 liters in can 2, that is another effect. Now what does it mean? Transfer of water from can 1 to can 2 affected two cans, one increase in one can and decrease in another can. Now if you try to apply this to the account, one account is decreased, another account is increased. Now if you post to the journal entry, how you will be posting? Benefit giving activity is known as debit, benefit receiving activity is known as credit. Now in this case we will be writing it as can 2 account debtor to can 1 account. Can 2 account debtor to can 1 account. What does it mean? Transfer of 5 liters from can 1 to can 2 that affected two cans. Can 1 there is a decrease of 5 liters, can 2 there is increase of 5 liters. Now in this case, this particular transaction has affected two cans. If you apply this to the accounts, it affected two accounts, can 1 account and can 2 account. So this is about the double entry system. So double entry system says that whenever there is a business or a financial transaction, that particular business or financial transaction will definitely affect two accounts. So that is about this particular double entry system. So whenever we apply this particular double entry system, definitely one account may increase, another account may decrease, or both the accounts may increase or both the account may decrease. So if we brief, once again I will brief about this particular double entry system. So double entry system is introduced by Luca Paciolo in 1494. So the major objective of this particular double entry system is whenever there is a financial transaction, it affects the two accounts. Two accounts should be affected, and the golden rule of this particular double entry system is a corresponding debit will have a corresponding credit, a corresponding credit will have a corresponding debit. So this is about the double entry system. Now we will discuss the types of accounts. So generally accounts are mainly classified into two types. One is personal accounts and the second one is impersonal account. And this particular impersonal account is again classified into real account and nominal account. So generally types of accounts are mainly classified into two types: personal account, impersonal account. Again this particular impersonal account is classified into real account and nominal account. So first we'll start with real account. So now we'll discuss the real account. So real account mainly deals with assets, liabilities. Real account mainly deals with assets and liabilities. And if you see the rule of this particular real account, debit what comes in and credit what goes out. So rule of real account is debit what comes in and credit what goes out. So already I said the real account mainly deals with assets and liabilities. So if you see the examples of assets, land and buildings, machinery, furniture, stock, cash in hand, cash at bank, these are some of the examples of assets. And if you see the examples of liability, bank overdraft, sundry creditors, debentures, bank loans, so these are some of the examples of liabilities. So if you see the rule of real account, already said that the rule of real account is debit what comes in, credit what goes out. Whenever an asset comes into the business, that particular asset should be debited. What does it mean? Whenever an asset comes into the business, that particular asset should be debited, and if asset is going out of the business, that thing should be credited. So rule says that debit what comes in and credit what goes out. Now we'll try to understand this particular real account with a example. Suppose if you see the example, If you see the example, purchased machinery for rupees 1 lakh. Purchased machinery for rupees 1 lakh. So this is a transaction. Now we will try to apply this particular rule of real account to this transaction. So purchase machinery for rupees 1 lakh means you can identify two accounts. In this particular transaction you can find two accounts. One is machinery account. One is machinery account, and how we purchase the machinery with cash. So the second one is cash account. Machinery account, cash account. Purchase machinery of rupees 1 lakh. This is a business transaction, and if you identify the two accounts are there in this. One is machinery account and the other one is cash account. Now we will try to apply this particular rule of real account to this. So what this real account rule says, debit what comes in, credit what goes out. So in this case, if you purchase a machine is coming into the business, and how you purchase this machine? Through cash. So cash is going out of the business. So what it says, if debit what comes in, so machinery is coming in, so that's why machinery account should be debited. Credit what goes out, cash is going out of the business, so cash account should be credited. Now if you write the simple entry for this journal entry, what we will be writing? Machinery account debtor to cash account. Machinery account debtor to cash account. Let us leave the amount, because anyway we will be discussing the generalization of transaction in detail in the later part of this particular module. So just we are trying to understand the rules of this particular accounts. So already said that real account deals with assets and liabilities, and if you see the rule of real account, debit what comes in, credit what goes out. Now we try to discuss with this real account with an example. That example is purchase machinery for rupees 1 lakh. In that particular transaction we can identify the two accounts. One is machinery account and the other one is cash account. So it says that if something comes into the business, that account should be debited, and if something goes out of the business, that should be credited. Now in this case machinery is coming in, so that's why we write machinery account debtor. Nothing but we debited the machinery account, and cash is going out of the business, so that's why we credited the cash account. We debited the machine account because debit what comes in, real account rule. We credited the cash account because debit what goes out, rule of the real account. So this is about the real account. So after this real account, another account is nominal account. Next type of account is nominal account. So this particular nominal account is also having a rule. So if you see the rule of this particular nominal account, debit all expenses, credit all incomes and gains. Debit all expenses and losses, credit all incomes and gains. So this is the rule of nominal account. So this particular nominal account deals with all the expenses and the incomes. Nominal account deals with all the expenses and the incomes. Now we'll try to understand this particular nominal account with an example. Suppose if you find the example, salary paid to staff 20,000. Salary paid to staff 20,000. So this is also a transaction, and if you try to identify the two accounts in this, we can identify two accounts. One is salaries account, and the second one is how we will pay the salary. Either it may be through bank or it may be through cash, but in this case we assume it as cash. So cash account. Salary paid to staff is a transaction, and if you identify the two accounts in it, one is salary account and the other one is cash account. So if you apply the rule of nominal account to this transaction, the rule of nominal account is debit all expenses and losses, credit all incomes and gains. So now salary is a expense. Salary paid by the company is considered as a expense to the company. So according to the rule of this particular account, salary account should be debited, because rule says that debit all expenses and debit all expenses and losses, credit all incomes and gains. Now in this case, salary is an expense to the company, so that's why salary account should be debited. Salary account should be debited. And if salary account is debited, if you see the other account, that is cash. What is the next account in this? Cash. Cash is a asset. All assets should be considered as a real account. Cash is a asset and all assets should be considered as a real account. Again, if you apply the rule of real account, what is the rule of real account? Debit what comes in, credit what goes out. Now in this case, company paid the salaries to the staff. Now what does it mean? Cash is going out of the company. Company paid salaries to the staff, so cash is going out of the business. So that's why if you apply the rule of real account to this, cash is going out. So whenever something goes out of the business, that should be credited. So salary account and this particular cash account should be credited. And if you write the journal entry, your journal entry will be like this: salaries account debtor to cash account. Salary account debtor to cash account. Why we wrote like this? Salaries is a expense. All expenses should be considered as nominal account. The rule of nominal account says that debit all expenses. So that's why we debited salaries. Cash is a asset. All assets are considered as real account. The rule of real account says that credit what goes out. So cash is going out. So that's why we credited. So this is about the nominal account. And if you see the other type of account, that is next account is personal account. Next type of account is personal account. And if you see the rule of this particular personal account, the rule of personal account is debit the receiver, credit the giver. Rule of personal account is debit the receiver, credit the giver. So in this case, in the case of this particular personal account deals with debtor and creditor. Personal account deals with debtor and creditors. All debtors and creditors will come under this particular personal account. So suppose example, now we'll try to know what actually debtor is. Debtor is nothing but the person who owes to us. Nothing but the person who should give some amount in future should be considered as debtor. And if you see the creditor, the person to whom we owe, nothing but the person to whom we need to pay cash in future is known as creditor. So debtor means the person who owes to us, and the creditor means the person to whom we owe. These debtors and creditors are considered as personal account. These debtors and creditors should be considered as personal accounts. So personal account rule is debit the receiver, credit the giver. The rule of personal account is debit the receiver, credit the giver. Now we'll try to understand this particular personal account with an example. So if you see the example, amount paid to Mr. X 10,000. If you see the example, amount paid to Mr. X 10,000. Now in this case also two accounts are there, Mr. X account and how we paid through cash account. Mr. X, amount paid to Mr. X. X is nothing but a personal account. X is nothing but personal account. Cash is nothing but an asset, so it is nothing but a real account. So if you apply the rule of this particular personal account, what it gives? Debit the receiver, credit the giver. Now who is the receiver in this case? Mr. X is the receiver. So Mr. X account should be debited. And the next thing, cash. Already I said cash is an asset and asset is a real account, and the rule of real account is credit what goes out. In this case also cash is going out, so that's why cash account should be credited. Now if you write it as a journal entry, your journal entry will be Mr. X account debtor to cash account. Why we debited Mr. X? Because according to the rule of personal account, we need to debit the receiver. In this case, Mr. X is a receiver. And why we created the cash account? According to the rule of real account, debit what, credit what goes out. So cash is going out. So that's why we created this. So these are the three types of account. One is real account, nominal account, and the personal account. Real account deals with assets and liabilities, and nominal account deals with expenses and incomes, and personal account deals with debtor and creditor. And if you see the rule of real account, that is debit what comes in, credit what goes out. And if you see the rule of nominal account, debit the expenses and losses, credit all incomes and gains. And if you see the rule of this particular personal account, debit the receiver, credit the giver. So these are the different types of accounts which we discussed. Now we'll discuss branches of accounting. Branches of accounting. So generally, if you see these particular branches of accounting, mainly branches of accounting are financial accounting, next cost accounting, management accounting, social responsibility accounting, and human resource accounting. Generally, branches of accounting is financial accounting, cost accounting, management accounting, and human resource accounting, and the last thing is social responsibility accounting. Now if you see the first one, that is financial accounting. If you see the first one, the financial accounting. So the major objective of this particular financial accounting, you need to first see the major objective of this particular financial accounting is preparation of financial statements, presentation of financial statements. Preparation of financial statements is one objective. Next objective is presentation of financial statements. So as I already said, the major objective of this particular financial statements is to know how to, actually it majorly deals with how to prepare the final accounts. So what are the different accounting policies, accounting principles, accounting standards which should be followed by the accountant to prepare the financial statements? Already I said that generally financial statements means trading and profit and loss account, balance sheet, and the cash flow statement. Trading and profit and loss account, balance sheet, and the cash flow statements are considered as financial statements. So the major objective of this particular financial accounting is it deals nothing but it majorly focus on the different rules and regulations, different accounting standards, different accounting concepts, and the principles which should be followed while preparing the financial statements. And if you see the other objective of this particular financial accounting, presentation of financial statements, it also focus on presentation of financial statements, how these financial statements should be presented before the different users of accounting. So it majorly focuses on how these statements should be followed, how these statements should be presented before the users. Already I said about the users may be creditors, debtors, managers, government, different accounting bodies, different taxation bodies. So financial accounting major objective is preparation of financial statements and presentation of financial statements to the users of accounting. So this is about the financial accounting. And if you see the next branch of accounting, that is cost accounting. Next one is cost accounting. So the major objective of this cost accounting is to calculate per unit cost of product, to control the cost, and to reduce the cost. The accounting which mainly deals with ascertainment of per unit cost of a product, reduction of cost, control of cost is nothing but cost accounting. Because in the present modern business, commercial and competitive environment, if you want to maximize the profit, the only thing available to if you want to maximize the profit, the best solution available to us is reduction of cost. If you want to maximize the profit, definitely we need to reduce the cost of production. So then only we will be having a chance of getting more profit. So in the modern business scenario, cost accounting plays a major and a vital role in the organization. So that's why nowadays cost accountants are very highly needed. So the major objective of this cost accounting is calculating the per unit cost of a product, nothing but ascertainment of cost, reduction of cost, control of cost is nothing but the objective of this particular cost accounting. And if you see the next branch of accounting, that is management accounting. Next branch is management accounting. So the major objective of this particular management accounting is preparation of nothing but already we prepared the financial statements, but why we will be using this management accounting is the major focus or major objective is to assist or nothing but to aid the manager in taking the proper decisions. So it majorly focus on preparation of those statements which is useful for the managers to take an appropriate decisions in the organization. So this is about the management accounting. The objective of management accounting is to aid or assist the manager in taking the appropriate decisions in the organization. So generally management accounting will be using the statements which is prepared by cost accountings or nothing but which is prepared in cost accounting, and it will be using the statements which is prepared in the financial accounting also. So this management accounting plays, it is also considered as a major branch, because nowadays the effective decisions which is taken by the manager is possible only by the management accounting, because it provides the required stuff, it provides the required information to the managers which helpful to him, nothing but which is helpful to the managers for taking the appropriate decision. So this is about the management accounting. And if you see the next branch of accounting, that is human resource accounting, and this is very simple about this human resource accounting. The major objective of this particular human resource accounting is how much amount is spent by the nothing but the total cost incurred by the organization on its human resources and the total benefit which is received by the organization from their human resources. So this particular human resource accounting mainly focus on the cost incurred by the organization on its human resources and the benefit received by the organization from its human resources. So this is something which is dealt by this particular human resource accounting. And if you see the last accounting, that is social responsibility accounting. So this is a very unique and this is a new concept. So the major objective of this particular social accounting is how much benefit is received by the organization from the society. How much benefit or nothing but total benefit received by the organization from the society and the amount spent by the organization on the society. So the major objective of this particular social responsibility accounting is benefit received by the organization from the society and the cost incurred by the organization on the society. So this is something which is dealt by this particular social responsibility accounting. So these are the different branches of accounting.